Hey guys, it's Chris Mincola with the Mincola Group over at West USA Realty, and we're doing our weekly market update. Just wanted to run through some of these numbers with you and make sure everybody's up to speed on what's going on. Things are changing quite rapidly, but there's some good news out there, and there's some things that you really got to understand so that we don't have this kind of everybody running around getting the clickbait of, it's 2008 all over again. And I'm going to explain to you why it's there certainly is a cooling off, and some of this is a little manufactured, but it's also nothing like 2008. And I'll explain why in just a minute. But let's look at the rates. The first thing we got to look at is rates, because this is really driving things big time. So we've got a 5.09% interest rate, down from 5.1 last week. Last year we were at 2.99%. So basically what that means in hard numbers is going from 2.9 to 5.09 is you basically need to make about $30,000 more to qualify for the same property that you would have a year ago. So that's a huge difference for people. We talked about this before, but if you go from basically like 3% to 5%, just using round numbers, you're losing about 20% in your buying power, or you're paying more, 20% more, basically for a 2% rate hike like that. And of course, we've got these rate hikes because of inflation, because of printing money and other things that have been going on with we factors that have, really the supply and demand of a lot of things, starting with energy. And so, we were an energy powerhouse a couple of years ago, but now we're not. So this is really driving it. That really drives the cost of everything. Your air conditioning, your heating, your food, all that has to be transported. All that has to be, brought to your home. And in a nutshell, when energy prices go up for whatever reason, whether you think this is more manufactured than not, whether we're trying to go from green energy too quick, or not, the bottom line is it's going to cost you more. Prices are going to go up. These are inflationary factors. So you can't really fight those numbers. But when the interest rates go up, your buying power goes down, or you're going to pay more along with the inflationary factors. So mortgage applications are down to the lowest point since December of 2018. So we're just seeing a cooling effect because it's costing more for everything, on top of the regular inflationary factors and prices going up. We've got this interest rate hike. And a lagging factor we're going to see is in the job reports, because we're heading into a recession. Some people are saying we're probably going to see some layoffs and sort of things just because of the way people are spending their money. Even though our jobs reports right now look pretty good. But a lot of that could be, again, loosening up of mandates, people going back to work, people getting off of unemployment, all those sorts of factors. So we've got, 390 390 was where we're at right now, increase in jobs. They projected only 318. Again, that's what they projected. Okay. The unemployment is 3.6%. They projected 3.5. And then the monthly wages have gone up 5.2. That is exactly what they projected. But we're going to see, maybe with some layoffs, because people aren't spending as much money. They're buying half gallons of milk rather than full gallons of milk. They just can't afford to buy all the extra things, maybe not going on as many trips and as many vacations because of gas prices and the prices of everything going up. We're going to see, spending, we're seeing spending habits change. So we may see some layoffs and wages eventually go down, because these indicators that we're seeing right now with, what's going on with the jobs report are going to be lagging a bit by, say, a month or two, maybe 3 months. 2008 versus now, we're going to talk about that big time, because a lot of people are really worried about the housing market. It totally understands, makes sense. People are nervous about what's going on, but I've got to share some more, kind of go a little bit deeper than we've gone in the past, even more, and kind of share with you why it's very different now versus 2008 and what those differences actually are. So nothing like the last time we had a housing bubble or a recession, just to kind of look at the lending practices. Okay, lending practices are huge, right? So the volume of loans in the billions with a credit score less than 620 reached this peak right around 2006, 2007. And even before that, they were in much higher numbers. But just to give you an idea, kind of the height of that was 375 billion loans with credit scores under a 620 credit score. Okay. So now we've got 20 billion below 620. Typically, you can well, if you have enough money to put down, but you still need a home loan. I mean, you can get a home loan for under a 620 credit score, even under 580. For that matter, the basic premise for an FHA loan, as far as the government's concerned, is 500. However, most lenders are not going to do that, below those rates, unless you've got a ton of money that you're putting down, and they're also going to look at other factors, not just those things. But that said, not to get too deep in the weeds on that, that's a big difference. 375 billion below 620 loans versus 20 billion. Why? Because the regulations are much, much, much more stringent than they were back then. Okay. People are in a much different situation, so that puts our market in a much different situation because the lending practices are much different. So, okay. So, we've got to kind of look at apples to apples here when we're talking about skies falling, chicken little. We're going to have another bubble. Okay. So there's one thing I wanted to point out between 2008 versus now. Also, when we're looking at, those are more just kind of national numbers now. And typically, most people today and most lenders today really, really, really would rather see you at a 620 credit score higher. That's why we kind of use that base of 620. At 620 or higher, your rates are going to be better, you're a little bit stronger buyer, and those sorts of things. There's other factors they're going to look at, like what's your job history like, and debt to income ratios and all those sorts of things, how much money you're putting down, of course. But lending practices are much, much more stringent than they are now. Before you could fog a mirror, say, make up a number of what you were basically making in a lot of cases, and kind of get any lending amount you wanted to. So 620 or higher is usually we want to see. Kind of the entry point is at least 580. Yes, you can put more money down, maybe get qualified below those credit score numbers, but typically want to see higher. Now, when you're up, higher above, so let's say 660, 680, you're going to get even better, obviously better rates, better payment. And then when you're above 720, you're obviously going to get even better there, and so on, as far as your payment goes and your terms. But let's look at, another thing that's very different is the supply. Anything you do with business, anything to do with business, and that includes homes, is about supply and demand. If you're the one that has the product that people want, whether it's in super high demand or normal demand, it doesn't matter. You're the supplier, right? So you're the one that's got what people want. So when you have supply, for instance, back during the crash, of 54,000 in Phoenix, this is for Phoenix now, Phoenix specific, 54,000 inventory, where a normal market is going to be more like, let's say 20 to 30,000 for a normal supply of active properties. When you have 54,000, that's double, almost 2.5 times that amount. Okay. So back then we had an overabundance, an oversupply of homes, whereas now we have had a huge, since January, went from about 4,000 to 5,000 up to about 9,000 to 10,000, given, depending on the day and the week. In the last month or so, we've had this huge, increase in supply, but that's still half or less than half of what we actually really need to be in more of a stable, balanced market where you have more of an even playing field between buyers and sellers. So huge difference between then with 54,000 plus inventory of active inventory, and now with about 9 to 10,000. Okay, and earlier this year, we had 4 to 5. So it's increasing, but it's not increasing to those even near the normal levels, let alone those crazy over active supply of homes that we had during the crash. Okay. So just to kind of give you an idea, back during the crash, we also had 5.8 million more households formed. I'm sorry, going back 10 years, we had 5.8 million more homes or households and homes formed in the past 10 years. Okay. So we we are still currently 1.1 million homes short of where we need to be, and that means that we're about 5 years behind. We're about 5 years behind right now of where we want to be as far as our supply numbers go nationally. For Phoenix, we're probably more like 6 to 7 years behind from the numbers that we have, where it's more like 6 to 7 years. So we have a long way to go to kind of catch up with what we're needing for that supply in order to keep up with the demand, even with the higher interest rates. Okay, even with the higher interest rates, we're still in a seller's market for the most part. Phoenix has always been a seller's market. Okay, and so these stats I'm giving you right now, again, are something to keep in mind with the national number of 5.8 homes formed over the last 10 years. And again, that we're 5 years behind on building right now. So we, during that crash, people stopped building because of the crash and the oversupply, and they just didn't have enough demand back then. They had to basically play catch up. So we're kind of, then they started building again, and they're trying to play catch up again with the supply instead of the demand. Before, we were so light on demand and oversupply during the crash. So we are in Phoenix, about 6 to 7 years behind. Nationally, we're about 5 years behind. So just again, when you get the clickbait, and it is clickbait, and the mainstream media, if you go back and see what they said during the crash, before the crash, after the crash, in the last several years, as far as, okay, the Phoenix market is concerned, especially, but a lot of national stuff too, you'll see that a lot of it's garbage. It is complete garbage. I mean, we were calling stagflation and inflation back in coming our way back in January, February, March of 2021. Why? You got a new administration, and you got new things that were going to be changed in the economy that were obviously going to bring stagflation, going to bring us back to a lot of things that we had during the 1970s. It's just the bottom line. Basic numbers, supply and demand, inflation works. And in the past month, we've had issues with the stock market and the bond market. So I'm not an economist, not a financial planner. Please talk to those people, and please talk to your, tax people, financial planners, and all that. But over time, real estate has definitely always won out over time. Even during recessionary periods, as I talked about a couple of weeks ago, even during those recessionary periods, a lot of times it doesn't mean a necessarily automatic decrease in home values. And right now, everybody is very equity rich. So please keep that in mind too. And that hedges inflation for a lot of people. It keeps them kind of out of those issues. That's where people build a lot of their wealth, is through their real estate holdings. So again, when you see that clickbait, remember, think about what's going on here in the Phoenix market. Think about what's reality, even nationally, and your own hyper local area. All right. So let's now talk about the CMI. We have the Crawford Market Index that comes out from the Crawford Report people. They are tied right in with our multiple listing service. And for decades now, they have looked at these numbers and they give us this Crawford Market Index, CMI, Crawford Market Index. If it's at 100, it's at a absolute balanced market. If it's 90 or below, it is a buyer's market. If it is 110 or higher on this index, it is a seller's market. So we see that this index is going down fast, but it's going down fast for different reasons. Again, stay with me, going down different again, but for different reasons, going down fast for different reasons than we had in 2008. Okay, very different reasons. All right. So we have the first of all, the top 4 cities, or we've got the biggest decreases is Avondale, Gilbert, Cave Creek, and Queen Creek. Okay, they are the biggest declines of at least 37% or more decreases in those cities. But remember, we started, in the with a lot of these were in the 400 to 500s to begin with several months ago. So we've had overall of all the cities, we've had a 33% decrease in the last month. And last week that was at 28% for the month. So we're getting an accelerated decrease for the cities that I talked about. Avondale, just a month ago was at 521. That one now is at 284. So that's a 45% decrease. Gilbert was at 420. We've got a 40% decrease, putting it at 250. Cave Creek, we've got a 220, where it's at 221 right now. It was at 353. That's 37% decrease. And Queen Creek, Cave Creek and Queen Creek Queen Creek is at 182.6. That's a 38% decrease from 296.6. All right, so we see these big decreases happening right now. But again, if you cut people's buying power by 20% or more, you're going to see a leveling off like this. It's not, again, Chicken Little, sky falling, bubble bursting type of thing. People have tons of equity. We're still in the seller's market, and the lending practices are different, and the supply and demand is much different than 2008. Again, just a reminder. Okay, so big differences there. Paradise Valley has the lowest decline of 22%, and that's the story there in a nutshell. So the Crawford Report overall is at 261.4. That's the overall deal on that. So that's another decline that we've got. Demand is at 95, and the supply is at 36.3. And here's a quote from the Crawford Market Index. The market has deteriorated at the rate at the fastest rate we've ever seen. Last time we saw a frenzy like this was in April through November of 2008. Okay, but again, remember what's causing this? Well, inflation, overall inflation of not only housing but people's buying power. What's the cruelest tax? Inflation. They have to pay more for milk, eggs, gas, everything, right? And then housing. But the biggest thing is we just took 20, in about a year, we took 20% of your buying power away. Okay, with these higher interest rates because of manufactured inflation, right? So we've got this slowdown, but it's different, very different than the other factors in the past, okay? Because before it was supply and demand, now it's inflation and interest rates, okay? So this is a more striking reversal in the CMI than we've even seen in that year of 2008. Okay, but remember, the CMI is an overall index of whether it's a buyer's or seller's market. It doesn't mean, it's not a decrease in people's values of their homes, right? We're still seeing that prices are still going up. even with this. Not as much, but they're still increasing. So it's what, what important to note is what's caused this, supply and demand. Prices are still going up. People still have equity, and it's inflationary factors and interest rates. All right. So again, we've got to keep those things in perspective and within the context of what's actually going on. All right. So with the supply, again, let's look at that real quick. At 36.3 on the CMI, that's about 64% below where we should be at a balanced market. But it has been going up since January. So and it's more like stabilized. It's right around 9 to 10,000. We saw that go up in the last month. We'll see if it goes up anymore. It's kind of just hung there around 9 to 10,000, depending on the day in the week, as far as overall supply. But prices continue to go up. Supply is still higher than it was before. Demand, in the past, meaning the demand is at 95. So that means the demand is still right in the normal range. All right, still right in the normal range. We've got the asking price. The asking price is different than the sales price, but the asking prices may be a little bit lower than they were before. All right. And listing cancellations and expires may actually be going up a little bit. Okay. We don't see an increase in short sales, foreclosures, or anything like that. All right. We don't really see an increase in that, though. And we see the actual sales price is still going up year over year and even month over month. So this is why we like to do this every week, to bring you the actual facts and what is really driving the market, what to be on the lookout for, why it's different from recession to recession, and why it was different from the 2008 crash till now. Guys, if you have any other questions, that's all I've got for you today. If you have any other questions, and it certainly makes sense that even some builders may not be going full bore right now, even though we need the supply, just because there's the inflation coming in. But there's other factors like getting supplies and a little bit of a labor shortage. Those sorts of things are also driving some of this. I've talked to builders all the time, and I talk to superintendents, and what's going on, and basically tell me, and we look at the permit numbers are actually have been going up for new builds, and they're trying to again catch up with the numbers that I mentioned to you before. But supply line issues, whether that they can get the products, get the things that they need, the supplies they need, and also the labor shortages are kind of holding some of that up, along with the recessionary, inflationary factors of whether or not they should go even further than they're going now and hire more people than they should right now. It's not that they can't necessarily hire more people all around, but it's whether or not they should right now with the current economic climate. At least that's what I'm being told personally on the street level. So guys, I hope that helps. If you're a buyer or seller right now, just keep in mind, especially in certain areas of town in the Phoenix area, we're still in a seller's market. Going with that, some people, like I said, usually we go with the appraised value, the average comparable sales value for your home, and kind of start there. What people were doing is kind of going at, let's go with the higher comp level and add 20,000 onto that. And then we're getting it. And still with multiple offers and bidding wars, when CMI was more, in the mid to high 4s overall, or up near 5. Yeah, sure. Now, things are different with all these inflationary factors and the interest rates. Does that mean we're going to have a 2008 bubble? We don't see it. We don't see it with the different factors we're dealing with. The overall CMI is changing and going down like before, but does that mean, we're going to see a bubble or market crash? No, we don't see that. I don't have a crystal ball. I'm not saying no for sure, but what I am saying is whenever you have, an issue with supply and your demand is still even average or better than average, not really going to see much change there, and the regulations are robust like they are. I don't foresee it right now, unless something other shoe drops, and we'll keep an eye on that. Again, you may also see a little bit more in the way of, instead of 20, 30 offers, you may, get an offer or two in the first week. We talked about last week, homes going under contract, maybe, a couple days or half a week slower, but that's still pretty fast. And if we're still at around, we end up this year at 25 to 30% equity gains, which is what we're kind of gauging for at this time. That's still way over the usual kind of normal balance market. If we were at that, which would put us more towards, in the Phoenix area, around 5, 6, maybe 7% equity gains. We're looking at more like that 25% or higher. So guys, let me know if we can answer any other questions for you. Maybe time to get out there and purchase a home now. Yes, rates are higher, but prices are continuing to go up, and it may be a good time for you to get in the equity game. So overall, over time, you will be able to gain that equity and gain wealth for you and your family. So if you have any questions at all, your specific situation, let us know. We can help you not only with the real estate side, but with the mortgage side. We have loan officers available that can talk to you, get you qualified, help you with any credit boosting or credit repair that may need to be done with credit repair services. And they can also give you some free consultation on all that sort of thing, as well as we can help you with any home value questions you may have, get you a buyer consultation as far as the process of home buying. And we'd love to be able to talk to you about any of those things when you're ready. Again, Chris Mincola, West USA Realty, 480-788-8569. Call or text us there. My wife Cynthia and I can be reached at that number. Also, home@mincolagroup.com, home@mincolagroup.com, or check us out online at mincolagroup.com and mincolahomes.com. We'll see you guys next time. Make sure you follow us, subscribe, follow us on social media, YouTube, Instagram, and Facebook. Talk to you guys next time. Thanks.